I am 56 years old and retired, and I'm considering getting a long-term insurance policy, and I feel a bit overwhelmed. I'm looking at two. One is connected to life insurance, but it doesn't have an inflationary rider, and the other one has a inflation rider, but it doesn't have life insurance attached to it. I don't have children, so I just wanted to know if now is a good age. Should I wait, or I forgot what else I was going to say. But what do I look for in a good policy?
Well, my first question is to consider whether or not you even need a policy. Do you have enough assets that would be able to take care of you if you needed care?
Right now, probably my total assets might be I've paid off my house, maybe $300,000 or $350,000, maybe.
Okay. So there's kind of a sweet spot when it comes to long-term care insurance. It was a really great product some years ago. There's still a lot of great products out there. It's just really expensive. And as much as healthcare has gone up, I wouldn't even consider a product that doesn't have inflation protection unless you're going to front load it. What I mean by that is getting as much coverage as you can now, not worrying about it going up, and still planning to grow your assets as much as you can to supplement that. So you don't have to get enough to cover everything. There's other things that you could do, you can sell your home. If you do need to go into a facility or get care like that, you could sell your home. That's another asset that you have. So if you're not concerned, if you don't have children and you're not concerned about passing along a lot of your assets, I believe that the reason that God gives us assets is to take care of those under our roof. So for you, that means you, and using your assets to do that is a good thing. So there's kind of a sweet spot. You have to make sure that you can afford the premiums. And when you're looking at it, you want to go ahead and just make the assumption that your premium will go up. Long-term care policies have long been sold, back 20 years ago when I was first starting in the business. There were a lot of companies that were selling it, and good companies. And, the sales pitch would be that they had never increased rates on their policyholders, and that was true. But they're actuaries, so the actuaries do the work of predicting what future costs are going to be and try to balance the money that they're going to get in and making a profit and all of that with what they're going to have to pay out. Well, they were wrong, because inflation was much higher in the healthcare industry. So now policyholders are either having to shell out more premium or they're having to cut their coverage. So I think you want to just spend some time considering, do you really need a policy at all? And then what is going to be the most efficient. So at 56 years old, I don't know what your health status is like and all of that, but you still statistically have a very long life expectancy. So could be, 15 or 20 years before you would even need to use it. So you have to look at, can I afford to pay the premium going forward? Is that going to put me in a bind? One thing that you're going to have to look at is on your assets. Are you drawing down on your assets? Are you spending down on them? And at what rate? If you're drawing down on your assets more than about 3 or 4% of the total of what you have, that your future ability to pay those premiums might be in jeopardy.
Okay, one last question, if I may. The lowest amount that I saw to pay for premiums was like $238. Would it be better, or should I consider just maybe investing that, and maybe by the time I need it, then it would grow? Could that be an option too?
It could. The thing about insurance is that you're leveraging your money. So, if you don't have enough to pay for something right now, like your car insurance, for example, if your car is worth $40,000 and you don't have $40,000 to replace it if you get into an accident today, but if you invested your premiums, you might have that $40,000 in, 20 or 30 years, it doesn't help you if you lose your vehicle today. So, if you have an immediate need for it, I would say if you have an immediate need for it, sounds like you have enough assets to pay for that, because it's not necessarily going to be a whole new set of costs. You're still going to have a lot of the same costs that you have today. And if you're still going to have a lot of the income that you have today, you might be able to use your assets to pay down on it.